Welcome to the Advisory Group's 2025 Midyear Economic Summit and Update Workshop. Let's first start with some introductions. My name is William Glenn, and I'm a Client Services Associate as one of our TAG team members. Also joining me tonight are Brent Beverly, the President of the Advisory Group, and Manny Chinche, an experienced advisor at the Advisory Group. Both of them are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. We find it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, estate planning, tax planning, and investment planning. Even though today's presentation is primarily about equity markets and tax planning, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's agenda is straightforward. First, we'll provide a review of equity market performance in the first half of this year. Then, we will discuss some strategies and ideas that you can consider for the rest of the year and beyond. And finally, we will share a brief tax law update. To take us forward, allow me to bring up Mr. Chinche. Manny?
Thank you, Will. Let's quickly recap the fact that 2024 was a year that rewarded patient and long-term investors with very healthy equity returns. 2025 started out on a strong note, and in February, investors again saw a new all-time high for equity markets. Then volatility started to reemerge. It's not unusual for equity markets to pull back after 2 great years, but what was uncomfortable was the high level of volatility we experienced since February. With the arrival of a new administration came significant changes and uncertainties which typically affect equity markets. And as a result of some of the new administration's policies, stock prices quickly fell into correction territory. And again, volatility increased significantly. If you had looked at the S&P 500 on January 1st and did not look at it again until June 30th, you would see that the equity market has risen for the year and reached an all-time high. However, as you see here on your chart, based on the day-to-day movements, you find a totally different story. A monthly review of 2025 shows why timing the equity markets and being wrong is not only dangerous, but very risky. Had you left the equity market in March, you would have missed May and June, which were 2 of the best equity market returns since 1990 and the best monthly return since November of 2023. That's why we encourage long-term investing. This is why trying to time the market is very dangerous. On April 4th of this year, the S&P 500 dropped 6%, its worst loss of all of 2025, and one of the worst days in over 40 years. Then just a few days later, on April 9th, 2025, the S&P 500 rose over 12%, one of the best days in over 40 years. And as we regularly say, trying to time markets can be dangerous. Getting emotional about market movements, also very, very dangerous. Equities are long-term investments, and as this chart illustrates, even with downturns, long-term investors who have stayed in the market for over 10, 20, 30, or even 40 years were rewarded with considerable gains. Despite market pullbacks, as you can see, stocks have risen considerably over the long term. The volatility is part of the investment experience. Downturns and corrections are common, and therefore your investment strategy should understand that. Historically, U.S. stocks have experienced an average 3 downturns of 5% per year, 1 correction of 10% per year, and another correction of about 15% every 3 years. We feel that volatility will still be prevalent in the coming months, so we recommend that investors need to be prepared with a well-diversified long-term financial plan. To discuss how other parts of our markets are doing, allow me to bring up my business associate, Brent Beverly. Brent?
Well, thank you, Manny. So let's first look at interest rates. Now, interest rates remained stable in the first half of 2025. Earlier this year, the Federal Reserve was anticipating 2 rate cuts for 2025. However, due to growing concerns with the current state of the economy, the committee has chosen to take a wait-and-see approach. The Fed is currently forecasting it will start easing only in December, with possible other rate cuts coming in 2026. Stand by for future news. The Consumer Price Index is a key statistic used to measure U.S. inflation, and it has slowed considerably since its surge to recent highs in 2022. Now, as of May, the year-over-year CPI, otherwise referred to as inflation, was measured at 2.4%, which is slightly higher than April, but overall, inflation is still trending in the desired direction. Now, the Fed is so close to its 2% target rate. This was the lowest we've ever seen since February of 2021. Now, however, tariffs levied by President Donald Trump are expected to reignite inflation in the upcoming months, according to economists. For the time being, reports have shown that prices declined for categories such as gasoline, groceries, apparel, used cars, and airline fares during the months of March to April, according to the CPI data. Now, the Fed closely tracks this core CPI, which excludes food and energy, and provides a good indication of where inflation could be heading. Now, for May, the core CPI, which excludes those things, was the same as April, which is 2.8%. Now, we've seen an uptick in inflation figures for this month. CPI has risen to 2.7%, and core CPI has increased to 2.9%. So slight increases there. So we continue to watch to see how the economy will be affected by tariffs and the new tax laws. We'll monitor how these and other elements have an impact on consumer price indexes. Now, bonds are not exempt from volatility. So 2 days after Liberation Day, the 10-year par yield curve rate fell to 4.01%, and the 20-year dropped to 4.44%. However, by mid-May, the 10-year par, I love this term, par yield curve rate surpassed 4.5%, and the 20-year reached over 5%, 5.03%. Bonds are often seen as a safe haven during times of equity uncertainty and volatility. However, like many things, bond yields remain uncertain in these markets. Many factors affect the rates, including direction of interest rates and inflation, geopolitical risk, trade tensions, you name it. So we use bonds when they're appropriate for portfolios, and when we do, there are several things we take into consideration, including our client's risk tolerance, time horizon, and overall investment goals. So please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against loss. Now, we will continue to monitor the Fed movements, rising interest rates, and see what they're doing to bond yields. So keep going. The cost of borrowing remains very high. Now, according to the Federal Reserve reports, the annual average percentage rate, or APR, average annual percentage rate for cards, these are credit cards, accruing interest in the first quarter of this year was 21.91%. However, now this is down a tick from an average of 22.8% in the last quarter of 2024. So for those seeking new credit cards, the interest rate will likely be higher. Now, according to LendingTree data, the average APR range on a new credit card is 20.77 to 27.78. So 20.75% to 27.75%, depending on your credit worthiness. While slowing down, shelter costs are still rising at a pace that's faster than pre-pandemic levels. Rent, home prices rose an average of 3.3% a year prior to the pandemic. The year-over-year shelter rate was 4% this last April 2025. Shelter costs represent a large portion of the consumer price index and remain a significant factor in that overall inflation calculation. The reciprocal tariffs could boost inflation and thus reduce the spending capacity of Americans. So let's spend a little time on tariffs. The U.S. and many other countries, including our biggest trade partner, China, are still debating trade and tariffs. At the time we prepared this workshop, they agreed to reduce tariffs for 90 days. This resulted in the equity markets rising out of correction territory, reducing many analysts' predictions for recession. To us, it seems like they're changing what the tariffs are going to be applied and how they're going to be applied on almost a daily basis. So we don't know where they're going to end up. Nobody does. When we look at the geopolitical world, tensions, unrest, military fighting in the Middle East between Russia and Ukraine continue to cause uncertainty, which is never a healthy thing for markets. Equity markets do not like uncertainty, and the current unrest can cause market volatility. So therefore, it needs to be watched and monitored. So even as the markets are hitting relative highs, be cautious. So where do we go from here? Most economists predicted a market correction defined as a decline of 10% or more could happen. And indeed, we saw it first half of this year. Now, do we see another correction? Could the U.S. experience a recession? Now, a recession is what occurs when the entire economy contracts for several months. Guys, our crystal ball still doesn't work. Concerns have risen significantly after the announcement of President Trump's reciprocal tariffs, where shortly thereafter we experienced a correction. Then, after a 90-day pause in tariffs was announced, it rekindled some hope of avoiding a recession in the near future. In late May, J.P. Morgan research lowered the probability of a U.S. recession occurring in 2025 to below 50%. Now, this is down from 60% previous. So it's a big adjustment. This adjustment is based on the temporary easing of trade tensions. Now, regardless of whether we experience another market correction or even a recession, this is a time for investors to remain vigilant and focus on your personal financial goals. Now, to go on with more thoughts on these things you should be doing, please allow me to bring back up Mr. Chinche. Manny?
Thank you, Brent. Now, here are 4 possible ideas to consider if we were to experience another market downturn. You can add new money to your retirement or brokerage account. Maybe you'll want to rebalance your portfolio. Now, these are good times to convert your traditional IRA to a Roth IRA if you have retirement accounts lower in value. And you should also consider strategic tax planning opportunities. Now, if you'd like to explore any of these, please call our office and we'd be happy to discuss these with you to see if they are a good fit for your unique situation. Now, here are some things to remember if the volatility were to continue. Turbulence in the stock market can cause concern among novice investors, but seasoned investors understand that volatility is simply part of the investing experience. Focus on a long-term diversified investing strategy that has taken potential volatility into consideration. Focus on time in the market, not timing the market. Please remember it is nearly impossible to determine when the perfect time is to get in and out of the market. Trying to time the market can prove to be highly risky, and many investors have missed out on significant gains by doing so. Take advantage of potential opportunities during market downturns. We just discussed a few opportunities that you could utilize during these downturns. Before making any decisions, though, please consult with us to determine if these opportunities are a good fit for you. Limit exposure to inflationary news and media. As you know, somewhere, somehow, reporting the fact. During uncertain times, for planning purposes, it is wise to have proper financial liquidity. This means that you should make sure you can meet your current and planned short-term and possibly even some mid-term financial obligations. You should always strive to minimize or eliminate unnecessary debt, and your focus should be on any upcoming short-term to mid-term obligations. Please let us know if you anticipate needing cash for a large obligation such as funding a wedding, paying college education, making a gift, or purchasing a new car. We can likely help you have funds available out of fluctuating markets to cover. As a recap of the first half of 2025, after seeing 3 consecutive rate cuts in 2024, the Fed is holding rates steady until it sees more favorable indicators. Interest rates remain at 4.25% to 4.5%. While the U.S. experienced a market correction, equities recovered very quickly. Volatility remains. We recovered from the correction just as fast as it came, but investors should still be cautious. Trade tension remains, and uncertainty around new tax laws will be key players in volatility. Staying the course and maintaining the consistency of a well-devised, long-term focused plan has historically served investors quite well. And last but not least, we are here for you. Please keep that in mind. Please remember, once again, investing in equity should be viewed as a long-term commitment. The first half of 2025 was a good reminder of why it's a good idea to stay the course, stay invested, and focus on your long-term goals during these times of volatility. And as mentioned earlier, equities recouped their losses incurred during the short correction that we saw. It was ugly but short. If you pulled out of the market and tried to time a good re-entry point, you could have missed out. We do not recommend trying to time the market quite like this. Focus on time in the market, not timing the market. Now, we believe that equity investors could have a better potential to meet their goals over long periods of time. Historically, investors with a long-term plan that stayed the course and remained invested were rewarded. We always abide by our equity market mantra of proceed with caution. Having a proactive approach to your financial goals and a solid investment strategy is part of the holistic offerings that we provide our clients. Now, while we cannot control financial markets, inflation, or interest rates, we keep a watchful eye on them. We want you to be comfortable knowing that we are staying apprised of any situations that may affect you. Our goal as the stewards of your wealth is to help you through uncertain times like these. We always attempt to help you create a well-crafted plan customized for your unique situation and goals that take into consideration how you will react to market ups and downs, including your time horizon, tax implications, liquidity needs, risk tolerance, and your overall personal objectives. If you have any questions about your personal situation, please call our office or talk to us about it at your next meeting. As most of you are aware, a new tax plan was signed by President Trump on the 4th of July. We want to briefly discuss some changes in tax law that we believe are important to investors now that the new so-called One Big Beautiful bill has passed. To give us more details, let me bring back up Mr. Beverly. Brent?
Well, thank you again, Manny. So we want to talk here a little bit about the One Big Beautiful bill. Has its term, that's not our term for it. Our goal here is there's many pages of fine print. There's some highlights in this new bill that we expect you may find useful for your personal tax planning. That's what we're going to focus on today. Tax laws instituted in the first Trump presidency under the Tax Cut and Jobs Act, TCJA, in 2017 were set to expire at the end of this year. Starting January 1st of 2026, we expected higher rates here. So without a new tax bill, we would have seen these big increases that you're seeing on the screen. The new tax bill makes permanent those previous rates, the existing rates, and extends those. So it makes them permanent so that we don't have to have another future Congress to change the rules here. So our chart here shows what the rates were scheduled to do in 2026, but those increases are now canceled. The bill extends and increases the current standard deduction. Another big change regarding itemized deduction is that the deduction limit for state and local taxes, SALT, has been increased from its current level of $10,000 to $40,000 through 2030. At that point, the deduction will reset to $10,000. Now, before you get too excited about that, be sure to check the phase-out rules on this. The rules are complicated, too complicated for us to go through today. Rather than making Social Security income tax free, the bill provides for a $6,000 annual deduction for taxpayers aged 65 and older. Now, at least for a few years, through 2028. The bill also extends the increased alternative minimum tax, or AMT, exemption. It further goes to make the increases permanent so that it would take another act of Congress to change it again. Another interesting one, the bill increases the child tax credit to $2,200 and makes it permanent, and adjust that amount by inflation going forward. So it increased it from $2,000 to $2,200 and then increases that by inflation, and it takes an act of Congress to change it. The new bill also increases the pass-through deduction for small businesses to subtract more of their qualified business income from their taxes, thus lowering the tax liability. It permanently extends the estate tax exemption. It's increasing to $15,000 per person, so $15,000 for, $15 million for singles and $30 million for married folks. One of the more intriguing new provisions is this account for U.S. citizen children born between 2025 and 2028. It's referred to in the bill as the Trump account, Trump accounts. But sometimes we see it referred to as the child savings account, or even, you're going to like this one, money account for growth and advancement, or MAGA account. These accounts are to be funded with a one-time $1,000 deposit from the government. Additional limited investments can be made by parents, and you'll like this, the parents' employers, with the funds then growing tax deferred and coming out as long-term capital gains if used for quote-unquote qualified purposes. Is that complicated enough for everybody? There are also new provisions for wage earners who have incomes from overtime or tips. Now, these provisions are temporary. They'll go from 2025 to 2028, and they have too many restrictions for us to list them here. So check the phase out, check the restrictions, but if you have income from overtime or tips, it's worth checking out to see how these might affect you. There are many more provisions in the new tax law that we're not covering here. In addition, even for the provisions we have covered, there are numerous conditions and provisions and phase-outs and phase-ins depending on complex personal situations. There's far too much fine print for us to even begin to cover here, so be sure to discuss your personal situation with your tax advisor and financial advisor. Also, as we find other key provisions we think may help you or other clients, we'll be including those in our future newsletters and presentations, so be sure to stay in touch. Now, later this year, we will once again be proactively exploring and sharing some end-of-the-year tax planning strategies. So our goal is to keep our clients informed of how the new bill can affect you and where we go. So to close us out tonight, please allow me to bring back up William Glenn. Will?
Thank you, Brent and Manny. This is a lot of good information. We're very grateful for our clients and appreciate the opportunity to partner with you in your financial journey. Another one of our goals is to help more people just like you. The best compliment is a referral. Some of our best clients were referred to us by existing clients. If you know someone you think may benefit from our services, or if you want them to receive additional updates from the advisory group, we would appreciate contact information so we can add them to our distribution list to receive our newsletters so we can invite them to future presentations. One of our primary goals is to keep clients informed, and we appreciate you joining us today. Please pause this recording so you can read through these important disclosures. If you want to reach out to us, here's our contact information at the bottom. We'll post this again in a couple of slides. We're thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first. Your health and well-being is always our highest priority. One of our major advantages as a financial advisory firm is the advisory group's team of financial professionals, while we like to refer to as our tag team. We hope you have had a chance to meet them. Here's the information for you to reach us. We are glad to be of service. This concludes our presentation. Have a wonderful year. Happy, healthy, safe, secure, and prosperous.